So thank you. So in today's presentation, I will explain how I prepare myself every day and how I communicate with my members. And then at the end, I will show you some charts about 2025 charts. Trading it can be complicated and it can be easy. It becomes easy if you keep on diligently working on improving yourself, your system, your setups, your trading rules, checklists, and the preparation. So what you're looking for. So laser focus when you come in the market. So laser focus of what you are looking for. So you are not trying to look for something else. You're looking for something which you are looking for. So laser focus on what you are looking for, and it appears. So if it appears, you evaluate that trade. If it doesn't appear, you don't. So you don't look for something which is not there. So that's what I have found. So I'll explain to you. So let's begin. So in this, there are two parts. One is the the whole method. I, it's not complete. It's not everything because it's just 1.5 hours. But I explain to you briefly, and then I'll show you at the end my charts for recent calls and trade puts trades. So um, recently I switched to calls. So these two quotes I got from the book called The Science of Getting Rich by Wallace Wattles. I stumbled on this book for about 15 years ago. It's available on Amazon, Audible, on YouTube. I suggest you listen to this book called The Science of Getting Rich. It's 2 hours. So out of these two, there are so many quotes. The whole book is full of teaching, you know. So the two which I got for you here, leave every person you come in contact with the impression of increase, and you get rich by doing things in a certain way. So there is a certain way the successful people they do certain things in a in a certain way. They operate in a certain way. They set their goals in a certain way. They handle their motivation in a certain way. They handle their stress in a certain way. uh, so they know about themselves. So constantly evaluating themselves and they're improving themselves along with the skills. So along with the skills, themselves and the risk management. So there are three components: the themselves, 60%, and then the risk management. Under the risk management is the how much and where you will cut your losses. So that one is the main component, and other two are belonging to risk management. So technical analysis comes at the end. So here's a quote by Bruce Lee. Again, I stumbled 15 years ago when at that time my mentor Chief. So Chief sent me this quote because I was looking for so many things. So he told me not to look for so many things, just practice one at a time. So so practice one, then two, then three, then four. So I'll explain to you what 12, 13 techniques or things I look for, and then I combine. So you need to combine. You need to make it 2 + 2 = 5. So Bruce Lee, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. Also, if you ask yourself if Bruce Lee was the trader, what kind of a trader he would have been if Bruce Lee was the trader. So think about that. You can go on YouTube and learn about Bruce Lee and what he said. And then there are legends. There are other legends. I'm preparing content on other legends, um, what they taught and how they achieve wealth. When I was learning, also looking for so many things here, there, and I did not know where to start. So again, my mentor, Chief, he said, look for Dinosaur. So in other words, look for the big money flow, where the big money is, where the money is coming in, because me and you cannot move the market. Uh, Either the big money is moving the market or the crowd is moving the market. So the wisdom of crowd. So pay attention to the wisdom of crowd. So we cannot individually move the market. We most of the time the crowd is right. So we need to look for the crowd. Sometimes the so that's where different between successful and non-successful traders. Differentiation is where to follow the crowd and where not to follow, where to just hold yourself that I'm not going to follow this time because I don't see it. Sometimes I miss it, but it's okay. So I follow my rules. I don't see it, I don't. But if there's a big money there or mm, the crowd is there, I need to pay attention. Plus, then apply your skills. So dinosaurs. So dinosaurs can run but cannot hide their footprints. So learn to identify dinosaurs. These dinosaurs, they can be institutional players, hedge funds, sovereign funds, pension funds. So imagine trillions of dollars are being invested. So they know where to invest. They know they have the resources. So right now it's Sunday, about 4:15 p.m. So what do you think? These big boys, they are sitting at home, just sitting at home doing nothing right now, enjoying, eating pizza, or they are busy uh, getting the news from all over the world right now. Even in their toilet, even in their bathroom, they have monitors. They have monitors, they have system even at home from each room to each room. When they walk, they are seeing the market. The markets are open right now. Somewhere in Timbuktu or Fiji Island or Tokyo, somewhere the markets are open. So they are getting the news, they are getting ready. And if we as a retail trader come to the market, so the market opens at 6:30 a.m. Pacific, and we come to the market at 9 a.m. and we will just open our Robinhood app and then see, go to some Facebook, see what my buddies are saying, or go turn on the CNBC or Fox News and see what ticker, and then I just buy it. And instead of buying um, 5 contracts, I just added, I just chasing it about 50 contracts just to look few dollars, like $200. So just buy my system. So the guru's selling, buy my system for $7, and during the first 5 minutes, you will make between $200 to $600. Just buy my system for $7, and I will show you. So that's what they say. I will show you. You just open your Robinhood, turn on, buy from anywhere from 200 to 600. So you will lose 6,000, 2,000 to 6,000, not make 200 to $400, $600. So pay attention to these big boys and be ready for the market. Come early, come like 5:30. When I was growing up, my uncle in India, so he used to wake up at 5. I wake up early also now. I mean, not for a long time. So he said, these birds you see, they are the one who these birds who are flying early morning, they are the one who will get their food. The other birds who wake up late, they are not gonna get the food. So wake up early, prepare yourself. So don't just come to the market at 9 o'clock and open your Robinhood app and instead of buying, you can afford 5 contracts and then you just push the button for 50 contracts or 100 contracts, and just like that, I'm gonna buy 100 contract and I will make $500. I'm out. Not, it's not going to work like that. You will lose. You will wipe out your trading account. Now, another thing. So if you go on YouTube or Amazon or buy some books, and you will end up buying books on mm, patterns after patterns and techniques and Bollinger Band and indicators, what not, and thousands of lines. You can put moving averages, this, that. So there's so many things. So just filter out what works and don't work. So again, so ask yourself uh, what you're trying to learn. So there are some, uh, I mean, learning is you can learn right now Latin. So go and learn Latin, but Latin will not help you, or some old language. Uh, so, so same way when I was learning, I was kind of stressed out. So again, sit down and ask yourself, what kind of a what I'm looking for. So what you're looking for is the reliable pattern, reliable techniques which work, consistently work. It has a risk to reward ratios. They appear constantly. They're not like once in a blue moon, certain head and shoulder appear, and then you identify correctly. And here's the neckline, and I will test the neckline, and here will be my entry. And then you wait for the whole year, and in it appears head and shoulders appear, and then you take it, and that's the trade which, and then you bet everything because you're so confident. You learn all your year about the head and shoulder, so you went overconfident, and then you put all the money, and that's the trade which is a loser. So you don't want that kind of a pattern to master also. I mean, it's good to master a head and shoulder, but it should appear all the time and you should be able to identify. So that's what I started filtering all the things which I need to focus on and just practice. So apply the Bruce Lee teaching on these patterns. So do that. Then so then you say, okay, I need to create my system. So it could be a visual, it could be a chart pattern, it could be a trend system, it could be a breakout. I will list about 13 of them. So so you ask yourself what kind of trades I'm taking. So here's the definition of your trading system. So developing low risk trade idea. So low risk doesn't mean um, that is a 2 cents stop that you enter here and then you get out, and then if you lose 2 cents and you make 10 cents. So that's not the low risk trade idea concept. The low risk trade idea is an idea with a positive expectancy, meaning that over the long run, if you combine all your losers plus the winners, you should be ahead in the game. Then it's the keyword exposure level. So exposure level meaning that if you lose in that trade, you are not hurting yourself. It's very easy to uh, get greedy. It's very easy to get greedy because we see the chart is spiking up and everything, and then we, as a human, we just increase our exposure, and then that's the trade which is becomes a loser, or it's not a loser. It will eventually turn out to be a big trade down the road, maybe 5 days, not today, not next 15 minutes. During the next 15 minutes, it will pull back and it will show a big drawdown because you have increased your exposure level. So if you're looking for a big profit, yeah, expect big loss also. See, expect the red, big red. So think about that. So if you expect big gains, you have to expect big red also because the stock will pull back, and if it pulls back, it will show the big red, and the big red is showing because the exposure level is high. So not only on an individual stock, but overall portfolio. So if you have one trade and then another one, and the whole market is going down, so combine the whole um, the exposure, A plus B plus C plus D, it will be a big red. So think about that also. So it's called portfolio heat. So you have to measure your portfolio heat also. That allows you to survive the worst possible contingency. So worst possible contingency meaning that there is a trade which will be 100% loser or a 50% loser. If it's a is I'm talking about 100% loser in option is possible all the time. 100%. You buy an option for dollar and the stock moves against you and it becomes 5 cents. So 100% loss you can see right away. In terms of a stock, the stock can cut also 50%. So if you look at the stocks since January of 2022, they are like most of them are, some are trading higher, but most of them are like 50% haircut, 100% in 1995. The look at the stock trading at $400, now trading at $5. So so think about that. The worst possible contingency in the short run. So what it means in the short run that even in the short run, you can see the drawdown But because of your exposure level and because you have a low risk trade idea, meaning the way the system is developed in such a way that you can achieve the long-term expectancy of the system. So over the long run, you will come out as a winner. So a low risk trade idea is a key, positive expectancy is a key, exposure level is a key, worst possible contingency is another key, short run is another key, long-term expectancy of the system is another keyword. So this four lines paragraph requires a lot of work, and we are not, as a human, we are lazy. We are not looking to work to come up with the system. We're just looking for easy money. So think about that, crafting and executing. So develop your system and then write it, write what you're looking for exactly, and then laser focus. If it's not there, it's not there. So if I give you my low risk trading game plan, you may not be able to execute. Or if I take your trading plan, I may not be able to execute because we are two different people. So having somebody's game plan doesn't mean I can also execute it the way the developer of that game plan expect me to execute. So developing is one thing, and then having a self insight in the mental state to execute is two different things. So same trade, 100 traders, 100 results because of the human emotions. So we know that. So did I? Yeah. Okay, so crafting your low risk trading game plan. So trading rules developed during planning process. So you have to work on this is a constant process, planning process, but there has to be a time where you say, okay, this is enough and enough. Otherwise, you become a perfectionist. So you can be an optimizer, but if you are operating as a perfectionist, then you will not be able to achieve anything because perfectionists never achieve something worth doing. So, I mean, worth executing. So they're just looking for perfecting it, and they never perfect it. So ask yourself again that am I a perfectionist or I'm just optimizer? I reach that level that I'm just need to tweak and optimize. Otherwise, my plan is working. Also, depending on the market. So at any given moment, you should be able to read the market, what the market is doing right now, and what is expected to do next few days. And based on that, you will be able to switch your hat. So you're looking for long trades and you're looking for short trade at any given moment. And the way the market is behaving, you should be able to know which side the market is moving. Is it to the upside, to the downside? Which way the market is moving, so um, you don't focus on the other wrong side. So trading rules, trading checklist. So tuck tuck tuck, the things are moving and you're checking one by one. You're rejecting it, you're approving it that this trade requires further attention, this trade reject, you don't need to look at it. Then there should be a monitoring process. You should know, you should have a written plan for the monitoring of the detail monitoring and the overview monitoring and the stocking. How do you stock the trade once it appears on your screen? So something appears on the screen, and then what do you do with it? So what do you do next? So write it down. So perfectly play the trading game, capitalize on the low risk trade idea. So the way it's supposed to be that you don't, the way the system is, the way you are operating, that you say, okay, once it comes into my other area where I need to focus, I will take the trade because it's a low risk trade idea. So I just start with 100 shares or one contract, and then if the trade, because when we are reading the chart on the screen, right there we are making some decision. So when we are making some decision, we can make the wrong decision. Just like little, when we go from San Diego to LA and we come back home, it doesn't mean that we did not do any mistake, or there are thousands and thousands of drivers on the freeway, they did not do any mistake. It's just that we avoided, we didn't do enough mistake to cause harm, and we avoided all the mistake by all the drivers on the freeway, and that's why we are alive. So little mistake like that, and boom, your portfolio goes down. So when we are executing the trade, we need to know that we could be reading the chart wrong, and I need to start small and then wait a little bit, then you can build your trade. So what do you see where you can say, okay, I need to add more to the position, and what method you have to add to the position? So scaling in, and how do you scale out? So this requires a lot of planning. So develop the edge in the market. So edge could be that you initiate small, you have a scaling method, you have a scale out method, you come early to the market, you prepare yourself, you're healthy, you're away from vices, you eat healthy food, you exercise, you come up early in the market. All this is your edge. So ask yourself, and just a second, water. So ask yourself, what edge do you bring in the market? There are millions of traders, and you're competing with millions of traders. So what is differentiate you from other traders? So think about that. Do you have a stocking process to control risk? Because stocking the trade allows you to reduce your risk and increase your profit by 100%, 200%. The same trade, you can take the trade. If you have a proper stocking process, you can increase your profit by 100%, 200%. So there's another um, presentation. I explain how you can increase your profit by 200%, 300% by simply adopting the proper stocking process, being very precise with entries and exits. So when you take the trade, do you remind yourself to go on a lower level chart? If you are taking the trade on a day chart is good to see the trade in front of you, because that's where the thing begin on a day chart. So everything during the day begins on a day chart. It doesn't begin on a weekly chart or on a monthly chart. It's not on a 60-minute chart. It begins on a day, because the day starts at 6:30 a.m. So when the day starts, the stock, um, if it's gapping up, it just lands somewhere. So it just lands somewhere on a landscape. Somewhere it jumps and then land. So after it lands, you read it, and then you can go on a weekly chart, you can go on a monthly chart, then you go on a lower level chart. So what process you have to time your entry, what you're looking for, and then executing the trade. So when you see, if you're trading options, when you're reading the chart, then what else are you looking for? If you're trading options, then you have to go and read the option data also to figure it out that you are not um, um, alone out there in the market. You're not paying something, because there's another level. Option trading is another level before the stock. This is another thing which the traders don't do, and I did not do when I started. They just jump right in option trading, because everybody says option trading requires only open an account with $500. That's it. They advertise like that. Pay me 200, but you can open an account with $500 and come with the Robin app, and rest is easy, and you triple your account. So that's not the way to do, because option is the sub level of stocks, and stocks are sub levels of market. So if you don't understand market, if you don't understand a stock, and if you're just trading directly options, what you're doing, I mean, so it's just a recipe for disaster. So don't do that. So when you see the trade, then you have to go in and analyze the option data and see if everything is correct. You have to analyze where the volume is. You have to analyze the option, the open interest, the spread, the volatility, and other Greeks, and then come up with your plan. So it's so fast. Thousands of variables are flying. When the trade comes in, so many things. It's like a fighter pilot. So think about it. You are in the battle, flying some fighter plane up in the sky, and there's a dogfight. So you have no chance. If you make a mistake, you're dead. So executing trade ideas flawlessly. And then once you open your trade, so you already have some open trades. So not only that, but then you have to monitor the open trade in a detailed manner. So the moment we open a trade, that's the trade we need to monitor in a detailed manner, because that's where we have a chance of making a mistake. If you're already in a trade, the mistake you already did. So it's doing its thing. So when we open the trade, we need to remind ourselves, I need to go and watch this trade in a detailed manner. So I teach all this in 8-day course. So if you're interested, send the email to my team, and uh, they will send you the detail. It's uh, it's an 8-day course, and I'm not charging you high price. So I explain to you in detail for 8 days. So being very aware of market conditions. So think about this. Now, there could be thousands of strategies and techniques and patterns. Some of them which I use daily basis. I listed down, there are 12 of them. And then there's so many things behind each. So I explain all this 12 in a separate presentation. So if you're interested, you can go on a real Trade Genie channel on YouTube and find this presentation advance where I explain, or I'll explain in a week or two again. So these are the 12. So I explained to you briefly, and then there's a detail, and then there is you can spend your life in each area. So I combine all this into, it depends what's happening at that time. So you can buy a black box indicator for $7. You can buy a black box for $7, and then the black box will say to you, green arrow here, red arrow, okay, buy this here and sell here. So you can do that. So behind the black box, there could be a complicated, very complex, like big boys. They automate their trading. They have the data, they have the expertise, they have the resources. They're looking for the keywords. The moment you speak A and B, so if let's say they somebody open the mouth, and their system is detecting the keyword A, and then they know either it will come as D or T or what is coming next. So they just barely spoke A, N, and then the system can put 2 plus 2 together and know the keyword, and they start executing the trade right away. So you cannot compete with them. So black box, it trades, and it enters and it exits. So if you can find that black box, is good for you. Another one is a chart pattern trading strategy. So reading the chart. So now the chart pattern is like, this is, people think they have mastered the chart pattern. So chart patterns like double top, double bottom, triple top, triple bottom, and flags and wedges and head and shoulders and this and that. So it's like reading the cloud. So you can say, oh, there is a dog over there in the sky, and I will say, no, it's not a dog, it's a cat. So different traders, they are coming up with a different meaning for the thing they are seeing. So this is not, you really need to understand what is happening. So you can combine the chart patterns with the reading of the bars, so like candlesticks. So spend your time in reading the charts patterns, combine it with all the bars reading, candlestick, etc. So this is another area, very big area. Band trading is another big area. People trade sideway market, so they go long when the stock comes to the lower line, and then they go exit when the stock touches the upper line, or is breaking out or breaking down. Plus they combine the moving averages, they put some indicator. So this is a whole new system. So if you want to trade band, you can trade, but it's not for me. So I do trade the channels, but not the band. So not the horizontal band. So trend trading is very important, but the traders, breaking the trend lines, whether it's upward sloping, downward sloping, what kind of a trading strategies you have, how many times the system has, or that market has touched the trend line, whether the trend line is a breakout, the trend line is a reversal, and how many times it tested with what volume and what's the duration. So all that you can combine into trend trading strategies. You can combine, so I do the detection of the trend change. So there is a trend, you can do the trend trading, which is the trend is already there and you're trading, you're looking for retracement. So most of the time, traders are getting in the trend very late. The trend is already there. And some they have a proper system. So they look for the pullback and then they enter. So they combine the trend trading with the support and resistance trading. So these two go together, plus the volume. So if you can develop your trading strategies based on the trend and then combine it with the support and resistance, then you have a winning system. And then you can put apply some breakout strategy. So the stock is breaking out from some resistance or breaking out after testing the support level. So it could be breaking the resistance or breaking the support and then bouncing up. So what it is doing. So think about this. So breakout and breakdown, you can combine it with the intraday reversal strategy. So you see breakout and breakdown can come up, you can combine with the intraday reversal strategy. You can apply the volume system also. So breakout, breakdown strategies, gap up. So I like gap up. I'll show you some charts of the gap up. So gap up. So not all gaps are meaningful. So a lot of if there are 9,000 stocks, all of them, almost all of them are gapping. So the definition of gap is if there is a price discrepancy between the close yesterday and the open today, you have a gap. So there is a discrepancy, meaning there is a difference between. If it's like a 5 cent difference, it is a gap. So not all gaps are meaningful. So you have to set up your criteria. What kind of a gap you're looking for? What is meaningful to you? And then when the stock gaps up, whether you will take the gap or you will ignore the gap. I'll show you some charts. So if sometimes you're already in the trade and the stock gaps up and it gaps up so big that you have to immediately decide and close the trade, because you may give up your profit very fast if the stock gaps up, and then you looking for trying to read the charts on a lower level and trying to figure it out. If I stay in this trade, is it hold, or you become greedy and then you lose your profit, especially in the option trading. So option trading, you see the profit, you don't see the profit on the gap up. And then there is the emotion side, because you've seen $5,000 profit because the stock gaps up, and you see 5,000 and then it's pulling back. Now you see 4,500, then you see 4,000, then you see 3,000, then you see 2,000. So you say, no, I will hold for another day. When it comes back to 5,000, then I will exit. So better, if you cannot read, just within first 15 minutes, see, go on the option if you have option. So if you go and see if option market has stabilized, because a lot of times the stock gaps up and the option market is not open because the market maker is still figuring it out where he will open the options. So first he take care of, see his books, and then the option is start to trade. So as soon as, so be remindful of yourself that this stock has gapped up and the option is not trading. There is a wide spread. This is not right. So I need to. So on one hand, you're watching the stock. On the other hand, your sell order is ready. So you think about it, doing all this in a one screen on a single laptop, or while you are working, or you have a iPhone, and you're doing all that, not going to work unless you exactly follow somebody's trades. They tell you to sell, you sell. They tell you to buy, you buy. So like I provide you newsletter so you can follow me. So gap down strategies, also the stocks gap down. So when the stock gaps down on a bullish market, pay attention to it. Maybe it's reversing to the upside. Maybe it fell to some support level and now it is reversing, intraday reversal happening. So if you're quick enough, you can take some action in, and you can reduce you're aggressive. So if you're doing the gap down reversal, you are being an aggressive trader. So not only gap down reversal, but you're applying the intraday reversal strategy, and you're reading the option chart, and you're reminding yourself that I need to look at the lower level charts like 5 minute, 15 minute, and actually see if the stock has gap down, where it's gap down. And then at the same time, you also look at some support and resistance where it gap down, and then maybe it gap down to some moving averages like 500 50-day moving average or 200-day moving average. So maybe it on a day chart it looks like it gapped down, but as actually it's moving up. On a lower level chart it has already bottomed. So you are going short where the stock is already bottomed out, and not that day, maybe after 3 4 days it will just, you know, uh, start to move up, because the beauty lies in the eyes of beholder. So now another thing, I have some charts, the symbols already prepared in different categories, so that I can, and I have familiarized with them. So when they are moving, I already know about them. So I just call them based on the chess game. So there are some categories missing here, but most of them are here. So like king, queen, horseman. So I call them, king, queen, knights, rooks, bishops. Then there are financial stocks, then there are oil stocks, and the retail stocks. So if you know the retail stocks are moving, then you focus on those retail stocks. So you already prepared the list of the retail stock. You already prepared the list of the financial stocks. You have a list of all the oil stocks. So if you see the oil stocks move, you hear about the crude, whether to the upside or downside, you open your workspace for that oil stock. If you see biotech stocks moving, you have a list of all the bio stocks which you trade. You open those and read the charts. Some of them are, then the rest of them, I just put them in a hardcore. I call hardcore, like I really need to focus on them. And then there are some other which I need to pay attention because they comprise of the market, part of S&P 500 or Dow Jones 30 or Nasdaq 100 or Russell 2000. So I watch all. And then when the market is bottomed out, like right now, the market bottomed out and moving up for last 3 4 days, especially the I see the small cap. So small caps are moving. So the small cap. So first, the big boys moved, like Nvidia, AMD, etc. So those big boys, Amazon, they started to move. Where the overall the market was down, but they started to move like 3 4 days ago. So if that happens, then others will follow. Other will wake up, and then small caps wake up. So so which small cap stocks you have to prepare your list. So small caps based on the fundamentals plus technicals. Sometimes the technicals um, create the fundamentals. So we also get caught that the fundamentals drive the stocks. So fundamental come first and then the technicals. That is not the right thinking. The technicals can drive the fundamentals also. So constant feedback loop. So think about that. That the technicals can also drive the fundamentals, not the fundamentals drive the technicals. So so especially in the small cap. So pay attention. Indices ETF. So now indices ETF we have to watch also, like Dow Jones, DIA, SPY, IWM, QQQ, then TQQ, and then URTY, and all these indices you have to monitor and watch and see where they are, and maybe you trade those. So pay attention to the ETFs in the market, pay attention to the futures market before the market opens, pay attention to the cash market, pay attention to the bond indices, interest rate, inflation, gold, and oil. All that you need to come up with your plan. If you just buying Tesla, only Tesla. So you will wipe out your account if you're just trading Tesla. You first of all, your account size may not allow you to trade Tesla. Your mental state may not allow you to trade Tesla. You don't have skill to trade Tesla. So I receive emails saying, one person sent me email like this morning. I've been day trading, and recently I see some success, and I think I can learn some option trading. So what this person is doing, first of all, he's doing the day trading. I don't know what is his portfolio size. You people do, they get caught in the day trading in some advertisement. They open the account because you can get the leverage or margin 1 to 10 or 1 to 5. So they put 5,000, and then they have the buying power to 50,000. They start day trading and they lose money, and then suddenly the market starts moving up, and then they start making money, and then they think, okay, they got this, I got this, now I am a day trader. So no, you're not. It just so happened the market was bullish or the market was very bearish, and you traded and you made money. It's nothing to do with you or with anyone else. So it's, and then so day trading, And then they go and they just start to trade option. So all wrong. So see how much work is required. Then inverse ETF, the gold and silver. So the gold and silver stocks are moving up. So all the junior miners and the miners stocks are moving up. So which one you can trade? So think about that. You should be ready at any given moment when you see the gold and silvers or mining stocks are moving. You should be able to trade them. So prepare your list. Only you can trade when you have already done the homework. You have the list ready. It's like ingredients are ready and they ask when you come to the restaurant and you order something and they have all the ingredients ready, they cook. They don't go and do the grocery shopping for you and then they come and they cook for you. It's not like that. So you need to have everything ready, set up. The moment the customer asks, you prepare. So the same way is trading. So here are some of the lists which I call horsemen, or you can call them knights. So these are the must stock. They move in a certain fashion and they move in a constant rhythm. So they are constantly getting bought. There's a lot of interest. Volume is there. They have a very narrow spread. Their options are good. And you can read these stocks even on a tick chart. So you can go as low as on a tick chart to read their movement. So Apple, Airbnb, Amazon, AMD, Baba, Baidu, Coin, CRM, Meta, Tesla. So all these, and there are some more in this list. I listed this because I run out of space here. So this is not the complete list. So knights or horsemen. Then there are kings. So I call them kings because they are high price stocks. So booking.com is like $3,000 stocks or $600. So I don't want to trade these in my options. Or I don't send these trades alerts, most of them, to my members, because if booking.com, if you buy one contract, it's like $3,000 or $4,000. So that if this trade goes against you, your portfolio is not allowing you to trade booking.com option. And if you open the trade of one contract, just one contract, $4,000, and that trade goes against you, then you lose like 2,000. And then when you see 2,000, which is only 50%, you will not exit. So don't. So if we trade, we trade the spreads. So these I call them kings, and then I call some the queens, like Boeing, Caterpillar. They need to be watched. Home Depot, Lowe's, FedEx and UPS, or NOC with GD. So these go together. So I watch them, I call them financial stocks. So these are the list of all the financial stocks. So American Express, CME, GS, JPM. So if PayPal is moving, I look at Square. Or if MasterCard is moving, then I also look at Visa. If Goldman C is moving, then I also look at a Goldman Sachs or Charles Schwab, American Express. So I look at the others. If I miss something, then, or if I spot, let's say I spot only C. So 3 days ago, C came on the screen and I read it. I said, okay, I need to go long on C. So if C is there, what else is building up? Maybe they are not just moving it, but they are eventually move. They may move, or is it the C is the only lone player there? C is moving for its own reason. It has nothing to do with overall financials. It's just moving. So if I enter in the C and 2 days later I'm out, so while I'm trading, I'm in the trade of C, I will start monitoring other financial stock. Or if I am in a Mastercard, so if I'm in a Mastercard, then and I see Visa is not moving yet, so Visa is just going up, going down, going up, going down, but the Mastercard is moving and telling me it's going up. So if Mastercard is moving up, the chances are the Visa will also go up. Not today, maybe after 2 days. Or maybe the MasterCard is coming up with the earning and then it starts to move. So same philosophy with the oil stock. So oil stock, here's the list. There are a few more stocks not listed here. I ran out of space, but these are the main. So Apache, CVX, Chevron, Devon, EOG, Fang, HAL, Halliburton, HES, MPC, OXY, PXD, VLO, Exxon. So if oil stocks are moving up and down, you will find one or two candidates out of this, which will make you money. And sometimes they are all moving in a nice fashion, either to the upside or downside. Then we have to remind ourselves that I cannot trade more than my maximum limit is 3 or maybe 2 out of all this, because if I trade open more than 2 stocks, combining the risk in two is it's like if I put 5% of my portfolio in VLO and then I put another 5% on Chevron, then I am exposed 10% in the oil sector. So I don't want to, maybe I need to cut down. So I need to balance it out. One trade I'm closing, maybe because that was the leader, that symbol was the leader, it was moving, and then all the other oil stocks, they wake up next 2 days. 2 days later, they wake up while I'm about to close the one I already in, because it's the reason I'm closing, because I have option trade and the stock is reaching the overbought level. So when the stock is reaching overbought level, it will pull back and then it will go up, but by then my option trade will be neutralized. It will come back to break even and I will see the loser in the option trade. So option you have to understand overbought, over level. You're looking for decent profits but quick profit. So when you combine the option trading with the stock trading, your gains can go to 50%, 100%. So um, so when we are filtering the stock, whether in the before market, like in the evening or at nighttime or in the morning before the market opens, or during the market. So how we are filtering it out. So filtering out based on the market analysis. So I'm filtering out the stocks based on the market. So what the market is doing, is it to the upside, is it to the downside, and what do I, so not only that day, if the market is overall, I expect the market to continue going down, and that day the market is up. So first of all, my put trades may not be working. So and then I shouldn't be going immediately on the long side, because I will be getting caught. So I have to remind myself that today is the day I need to be patient. So look at that liquidity. So put some criteria how liquid that is. The minimum criteria, let's say 500,000 shares or 1 million shares. So you have some liquidity. It's not very volatile, or you don't want to trade the dead stock, which doesn't move. It moves like 20 cents. So I don't want to trade AT&T and Verizon for options. I'm not. I don't trade them unless there's something really extraordinary happening. Don't trade Verizon and AT&T. Technical analysis, so filters the based on the technical analysis. Fundamental analysis, you can read fundamentals, but remember, technicals can drive the fundamentals. Fundamentals. If fundamental is deteriorating, going down, then the maybe technical also telling you, or the technical is telling you first, and then the fundamentals is improving. So just don't think that the fundamental come first and then technical. The technical can come first and then the fundamentals, because if the prices are moving up, somebody is seeing the beauty lies in the eyes of beholder. The fundamentals are improving. Option analysis, so pay attention to option analysis, what the option market is telling about that stock. Sector analysis, overall sector. News and catalyst, any news there, any price pattern you can read. But remember, what you see as a dog in the cloud, I may be seeing it as a cat. So we do have a tendency to make the patterns, give meaning to the patterns. So pay attention. So trading volume, so not only analyze the price, analyze the volume also, which is very important. If you're paying attention only to the price and not paying attention to the volume, you're only looking at the half picture. You need to look at the full picture. If the volume is not there, then you are the only one buying it. Nobody is following. So need some volume, need some proper volume. So proper volume analysis. So do you have the skill to analyze the volume? And then the risk reward ratio. So where sometimes the chart is looking good, that is way overbought. You may be trading at the overbought level or oversold level. Then you have to prepare your time frame for your charts. So time intervals. So these are the time intervals, and they are, you can say, um, short-term time interval, medium-term time interval, and a long-term time interval. So think about this. If you create a workspace of 195-minute time frame, daytime, weekly, and monthly. So this is one time frame, and then you take another time frame workspace, and then you say, okay, starting is 195, then 130, 78, and 39. So you put these four into another time frame, and then you say, okay, another workspace, and then you create the third workspace, which is 39-minute, 13, 5, and tick chart. So there is a continuation, and the reason I divided into these time frame because there are 390 minutes in a day. So daytime has 390 minutes. So there is one day, 390 minutes weekly. So there is a 5 day comes become a week. And then if you divide the day into two, so 390 divided by 2 is 195. And then the same 130 it goes divide into 390, 78 divides into 390, the 39 divides into 390, then 13 also divide into 390. But then after 13, you cannot divide 13, either 4 or 5. So 5 is good enough, 5 minutes. So most of the time, I'm just going into 5 minute chart time frame to look for my entries, either entry or exit. The nights, the Apple, Amazon, etc. You can read them properly even on a tick chart because they are moving. There's thousands of transactions happening, and there's a lot of volume, lot of action, lot of traders there. So when lot of things are happening, you can go into the tick chart. If there not lot of things are happening, I don't know how you can read the tick chart. So the lowest time frame is a 5 minute. So these time frame you have to be ready on a daily basis. And then another one is a price filter, volume filter. So you need to apply the price filter. So you don't want to trade penny stocks. So all these, buy at 60 cents and then sell at 65, and it doesn't go to 65 cents. It goes to 5 cents. So have some criteria of a price filter. Don't trade. They are penny stock for a reason. They are cheap. There is nothing there. So don't trade penny. Price filters, volume filters. If there is no volume, there is reason there is no volume. Because the big boys, all those big boys with a lot of money, they are not trading penny stock. They are not trading, may have the knowledge based on the fundamental. They may be buying a $2, $3 stocks, but they can hold forever and we don't. So I don't trade a particular price level. I don't trade volume below certain levels. So you need to put some filters of average true range. So if the stock moves $2 on average and it's moving $1.50 or $1.80, $2.50, there is something going on with this stock. That's why it's moving beyond. But apply this filter, but pay attention to the price extreme because it may have reached the extreme level. So you don't want to go to get in at the extreme level. Percentage change in the last X minute. If something is moving during the last 5 minutes, a certain price, then you need to see that stock, which is already in your watch list, and then you're seeing it, why it is spiking, or there's a spike in the volume. So it's a spike in the volume. Traders, this is what traders do. They see the spike in the volume, run somebody they somewhere they say, I see the spike in the volume, 3 minute time frame. I see the spike. So you know it doesn't mean that stock will continue. Somebody bought or somebody sold. First of all, you don't know what kind of, if there's a spike, somebody bought it or sold it or what it did, and that's it, done. That spike little bit, somebody bought 1,000 shares, 2,000, and it spiked up and then it comes down. So you need to know what is this, why there is a spike in the volume, but pay attention. Then I combine all this during the day. So I don't know about you, but I combine all this into different kinds of alerts. So I have built a system to spend a lot of money on it to give me all the alerts. So opening range breakout alert. So if the stock is moving after certain time interval, if it's making a new high or new low, I get the alert. New intraday high made, I get the alert. I need to know if the stock has made a new intraday high, because if I'm already in the trade, um, if I'm already in the trade and it's trading at 103 and my target is 105, so it's moving up, at 103.50, and then it comes down, and then it goes and go to 103.7. I get the alert. I say, okay, I got okay. It's made a new high for the day, or it made a new low, or certain percentage up. This one is 3% up or 2.5% up. So certain criteria. You don't want to set all the alerts, which is bogging you down. So I don't. So have some way of getting only the meaningful alerts, not 10,000 alerts, because if 10,000 alerts, then you are not reading any alerts. Volume alerts, if there's some abnormal volume occurring, you need to watch if the stock is moving above resistance. So how do you get the alert for break, but the point is that what is the resistance? How do you read the resistance? So how do you read the resistance? How do you read the support? What kind of support? Is it a so I have a way of analyzing the support and resistance. So I've been doing it for a long time. So when I see the support, strong support, I mark it as a strong support or a strong resistance. So I've developed the system of rating the support and resistance, and I do all that. So when I get the alert, I know what kind of support and what kind of resistance is breaking, so I can take some action. And when the sharp reversal is happening from resistance, so if the stock goes to the resistance and come down, then I need to know that it's coming down from the resistance. If I'm already in the trade, I really need to get out. Um, so most of the time, like now, almost 100% of the time, when I'm in a position and the stock is reaching some kind of a resistance, I don't wait for that resistance to break, because I can always get in with a different strike and a different month when the resistance is broken, than to wait for my position to break the resistance. And what if it doesn't break? It just start to crash on me, and I give up the profit. So I can roll my strike and the month next one. So if I'm holding, let's say 20 strike, and the stock is already at 24, 25, so I can get out and then see if the pullback happen. And then if I see the entry, I can open another trade at 27.50 strike or 25 strike or 30 strike. I'm not, so I need to I need to stay disciplined. That's what it is. I need to stay disciplined when I see the stock is reaching the resistance, and and it's a meaningful resistance, and I need to get out. I need to get out. I can decide later to get back in. Certain crossover moving averages, so 50-day crossing over 200-day, etc. So pay attention to that. Also, when we see the trade, so we need to have a proper process of stocking the trade. So two hats you can wear during the day. You can wear a hat of a long-term trader, or you can wear the hat of a day trader. So even though you are a long-term trader, you need to act like a day trader in terms of your entry. So when you enter, you remind yourself that I need to find the best possible entry. Even you are a long-term trader, you are going to hold this position maybe for 2 weeks, 3 weeks. You need to act like a day trader. So you have to remind us. We have to remind ourselves that I need to act like a day trader. So this is the definition of stalking. So this is a big topic I explain in my 8-day course. Just giving you the definition here. The essence of stalking is to find the best possible price for entry. Thus, stalking is another form of risk control. Through stalking, you can double your profit. Simply, same trade, same dollar amount you're going to invest, but you're doubling your profit. So there is a uh, reason for stalking the trade. Now, here's the example. So after doing all this, let's say you are my member of Swing Options and or any other service. So if I see the trade, and after I doing all that, so I send you the alert via Telegram or email and chat, SMS. So here is the in the short, it will say like this: CME. Let's say this is the stock symbol. What kind of a trade? It's a call or a put. So I put that November 210. So November is the month 210, buying to open at 5. So buying to open at 5, and the email. So this is what you get as a in the subject of the email or the alert. But in the email, it's broken down So if you read the email, it will tell you this also the third Friday expiry option. So if another week is not specified, then it means the third Friday expiry option, because that is the most liquid, um, where the most of the action is on third Friday. So you get this alert instant within a second. Within 2 seconds, you get the alert. I push the button and then you get the alert. I also get the alert back to me. And my team also get the alert. So we know the alert has been delivered. And then we can see in the option, that alert is delivered and their traders are buying. So now you have already done. So I don't know how much. So people send me email saying, "You send me this alert. You didn't tell me how many contracts to buy." So I don't know how many. What is your portfolio size? You have. I have members who have $2 million, and I may have member who have only $5,000. So the $2 million member, he may be buying 50 contracts, and $5,000 member should not buy even one contract, because his portfolio does not dictate to buy Apple option or Tesla option. So he's not supposed to trade Apple and Tesla because he has only $5,000 in the account. But I don't know that you have. So limit orders. So that's one thing. You need to know how many contracts you're supposed to buy. So there is a mathematical formula of risk management. You have to apply that, and that's another topic. So you calculate how many contracts you're supposed to buy, and then you put that order. So it's a limit order. It's not the market order. So we don't chase, and you get filled. It's not like my stock is going crazy and you don't get filled. Usually you need to shave your spread. So if there is a little spread wide, maybe 30 cents or 40 cents, then shave it. You get it, and don't worry if we don't fail. And I'm watching it. If there is a need, I send you the update to buy up to this price. And then my guidebook, I explain how many cents you can pay extra. Also, don't leave your buy order forever. So because you don't know what, after you set the buy order, what's going to happen to the stock. If it doesn't get filled, even if you're trading your own, you cancel it after 5 minutes. You don't walk away from your buy order. So you unless you're 100% sure, or it's a $2 or $3 below your trading price over there, and then you say, okay, I don't mind if it comes to $3. That's the price I want to get filled. If that's the kind of trading you're doing, it's okay. But I cancel my buy order. If I see it and I don't get filled, push the button, cancel, and you can put the order again. Also, after sending this alert, I send you the target. So some members, they are not in front of their computer, or they didn't read it, busy. So they have the targets available. So they know the stock price, because I specified the stock price where we enter, and then the target. So three targets are there. So you can decide on your own also, where is the target and where is the stock price, and then compare the price of the option and the current price. So what was mentioned in the alert and what is the current price. So do all that. And here's the guideline I provide in my email. Also, I send you the email. I also explain the guidebook. You can pay this extra. So if the option is trading between 70 and $1, so you can pay 75 cents. If it's a Tesla and it's trading between 12 and $20, and the alert is sent to buy at $12.05, but it's trading at $12.40, maybe you can pay $12.40 because it's okay. Tesla moves big. So paying 40 cents extra, uh, the profit could be $800 per contract. So don't haggle too much. In other words, you can always buy one or two, and then you can add depending on your portfolio size. So don't be over anxious. Don't chase. The stock trades in a range. It's not like it's going crazy. I'm not a Momo kind of a trader, so I'm applying all those technical skills, etc., and watching it, stalking it, reading it, and then sending you the alert. So don't need to worry about it. Now, when you are entering in the trade, you need to know where you enter and where you exit. So you need to be like Robert De Niro. So in one of the movie, Robert is a gangster movie somewhere in Europe, and he's with his buddies, and he's going in. He's with his buddies to meet with other gang members inside the building, and then he's telling his buddies, wait for me here, I'll be back. And then he goes and come back after 10 minutes. So his buddy asked him, where did you go? So he said, I went to see when I'm going in, when I'm coming out, due to any reason, I need to know from where I will be coming out from this building, meaning he was looking for the window where he will jump. So we need to know where you will jump out, either at profit or at a loss. So the target should be like a precision guided missile. So the stock is doing its internal map, is doing its thing, is moving. So it's moving from San Diego to Seattle, but in on the way, it is stopping. But eventually you know where it's going, and this is where you will exit. At that point, if you're trading stocks, then the dollar move is the same. So it's not making any difference if it reaches there in 10 days or 15 days. But if you're trading option, then it makes the difference due to time decay. So if you if that stock hits the target in 2 days, the option price gain will be higher than compared to if the stock hits same target in 10 days. So think about that. Traders, they just put their own objective in the trade. 40%. I want to gain 40%. Okay, 40% in what time period? Is it in the next 2 days or in the next 20 days? Because in next 20 days, the stock has to move a lot to give you 40% gain in the option. But in 2 days, yes, 40% is right there. So the time factor is there. So in option trading, don't be very rigid in terms of percentage. Think about that it takes time. If it takes time, then the gain is less. So pay attention. You have to read the stock chart, and what is there is there. It could be 40%, it could be 100%. If it goes jump right next day, gap up, it could be 80%. It's not 40%, it's 80%. And if you have set the target of 40%, you are out at 40%. Now I provide three targets, and there is a reason I provide, because the stock is straight is moving in a zigzag fashion, and it takes time to reach the target. It does its thing, a lot of hurdles in between. The market does its thing. There could be some news coming out. So there's so many variables coming in, and then finally the stock goes and hit the target. And the reason it's hitting the target and retracing, because of the if it's a long position, then it has the resistance levels. So how you analyze the resistance? You can analyze on a day chart or a weekly chart, but the clear resistance and support comes uh, to you in the intraday chart, like a full landscape, like you're watching the panoramic view. So have your chart in a panoramic view, which is a 15-minute, 30-minute chart over several days, several months, and then you can combine maybe 60-minute, 195-minute, etc., to come up with all the twists and turns where the stock has made is evident in the intraday chart. All the twists and turns are not evident on a day chart or the weekly chart. Day chart is just a bar. It's not clear, because if you look at the day chart, there is an open, so every bar has, or every candle has an open, high, low, and open, close, and low and high. So it's right there. But all the twists and turns it took to reach that high or close is clear on an intraday level. So intraday level gives you the clear target. So don't forget to look at the intraday level. So that's what I do. I go and look at the intraday level, and I start drawing lines. I draw the support and resistance line as fast as I can read, and I draw it. When they hit, I get the alert, and then I reset it. So I get the meaningful support and resistance. So I'm drawing the lines, meaningful targets. So the green target is easy to achieve. Is the green, that's what is, so based on the traffic signal. Even my little children, they know daddy is supposed to stop at the yellow light. So my son, he's 5, he immediately points out to me, Daddy, You didn't stop at the that the light was yellow. So he's telling me that, Daddy, you're supposed to stop at the yellow light. Red, everybody knows, but even at yellow, you need to stop, don't cross. So that's the concept, that the green means green is you can go through. Even at the green signal, you have to be you have to be a little cautious when you're crossing the intersection at the green, because there's some guy coming in from the other side. You're not overlooking, you're always in suspicious and alert and vigilant. So you're on high alert even you see the green. But overall, when you cross the signal at green, you will be safe because you're expecting others to follow the rules. And so you're depending on them. So green target is like that. You're expecting the stock to go and hit this, at least this green target. And it's a meaningful green target. It's not, the shorter is the duration of the target, the high probability it has to achieve. So in the short term, uh, so the day trader, what they do, they buy at 100 and they want to sell at 140 cents. So $100.40. So this 40 cents is very a high probability of hitting it. But so, but if their entry is wrong, then it doesn't go to $100.40. It goes to 99, 98, 99, and they become a long-term trader. They don't have any stock. From day trader, they become a long-term trader. So the green target is expected to be hit high probability. So if you're going from San Diego to LA, you have a high chance of reaching it at the right time. Whereas if you're going from LA to Seattle, you will reach, but you will not reach based on what the GPS is telling you. You will reach whenever you reach. Well, it depends how long what kind of a stop you took, etc. So I send you the alert to sell at one third or one half, etc. Mostly I don't send the alert if the green target is crossing and the stock moving towards yellow. Then I send the alert to hold, don't sell, or I change the target. So if you have 6 contracts, you're selling 2, but most of the time we are holding it. If it breathes, if it goes through quickly, then don't sell. But if I send you the alert for sell one third, then I document it. So in my system, it's documented that send the alert to sell one third. So the other 2/3 is still there. So I know it's there. Or if I if the stock goes to yellow target, so yellow target is determined based on some kind of a resistance. It's not a major resistance, but there is a twist and turn over there. The stock is expected to hit and then have like a pit stop. So it's supposed to uh, rest. It may rest for a few days or it may pull back towards green. So if that is the kind of a target or the resistance, then it has a 85%, and it has a 85% probability of hitting. So I send you the alert to sell one half or 3/4 of your position. So if you have 8 contracts or 4 contracts, you're selling half of it. If you have just 1 contract, then you're selling all. So, and the way the yellow target is defined, where the gain is at least 40, 50%, 50% gain in the option, and it has some kind of a resistance there, or some, if it's a short position, then some kind of a support. So either support for the puts and resistance for the long side. So I document that. So my system automatically document what we have sent. So we know that I send you the alert for sell half or sell majority or sell. Sometimes we send the alert to sell all, because that yellow target, when I read it, so the stock on its journey is creating its resistance and support. It's new resistance and new supports are getting created. So support and resistance, when you're reading the charts of support and resistance, you're reading the past history, and that's where you're making the decision that in the past, the stock has done this thing. It has so the support and resistance is created based on the psychology, based on all the trading actions happen, based on all the volumes, etc. So you're reading the past history. So it's good to read the past history and then decide that it will do the same. You expect the same thing happening again. So that's your decision. But so you define your yellow target somewhere else, but the stock can create its own resistance, a new resistance way before. So way before your the resistance, you're reading it and defining it as a yellow target. So if that happens, then I send the alert to sell all, because the stock goes, hit, come back, goes, hit, come back. So when I expect that, I send you the alert to sell all. Or maybe there is another position. I'm getting ready to send you the alert. Maybe this oil stock has already moved and have a 60% gain. And that was the only stock in the oil which was moving meaningful way, and others have just started to move. So other oil stocks have a greater potential than the stock you're holding. So think about it. It's just a symbol. So all these oil stocks I wrote here, they're just a symbol. So these are just symbols. These are the companies behind it. All the things are going on. So if we are in EOG and 60% gain and it hits the yellow target, so think about it. If EOG hits 60% target and it has a resistance there, and at a red target, which is a higher target, you tend to make 80%. So you are expecting another 20% gain, and you already have 60% gain. So you're risking 60% of your profit to make that extra 20%. So the higher the stock is reaching towards the target, your risk is increasing. So think about it. Your risk is increasing when the stock is approaching higher and higher. If it's you have a long position, your risk is increasing because you have a chance of giving back your profit. But it doesn't mean that you tend to ring the register willy-nilly, because if you ring the register, like they say, you don't go broke taking profit. You will go broke taking profit if you take quick profit and you take slow loss. So if you take slow loss and take quick profit, you will go broke. So the taking the profit at the proper time is the art and science and your skills. So if you recognize that you are in EOG already, you have 60% gain and it's coming at yellow target, and the red target you will make another 20%. But there is a stock called FANG which just started, and the yellow target is far. So there is a brand new 60% gain you have a chance of achieving compared to only 20% gain in EOG, and you expect to lose that 60% gain. So you ring the register. So when I look at, I switch, I send you the alert. So we may be closing one oil stock trade and sending another oil stock. So you may see that. So I may be closing MasterCard and opening Visa trade. So because MasterCard was moving, it has earning, it was doing its earning run up, and now MasterCard has come up with the earning, it gapped up, it moved. Now the Visa starts to move. So the traders are a bunch of, you know, they're just out there. They see MasterCard earning came and it gapped up, and then they look at Visa, and then the Visa starts to move. So you sell MasterCard and you switch to Visa. It's just your the two credit card in your wallet. Sometimes you pay by MasterCard, sometimes you pay by Visa. It's just like that. Now, the red target is defined as a major target. So when I'm defining the red target, it's at the overbought level. It's at the level where the stock has a very high probability of retracing. So uh, if your first of all, when you're trading, even if you're trading stocks, you you unless you are a day trader, you're trading only 4 or 5 stocks. If you are a position trader, you should have like 20-25 positions open, and you should have a way of managing those 20-25 positions in different sectors, different industry group, 4% here, 5% here, 3% there. So your risk is not just focus on one. Unless you are 100%, some angel came from the sky and whispered in your ear that this is the stock you need to trade and go all in, you can mortgage your house and bet everything on this stock. So unless the angel comes, you shouldn't be betting all. So divide your trade in different. So this trade you're closing, this trade you're opening, this sector is moving, this sector is moving up, this one is going down. So the red target is defined as the major resistance. So, and it has a 70%. The higher the target, the longer it will take to hit, and the probability go down. So because It's a far distance. If I enter at 100 and I my target is $100.50, it has a very it's like a 99% probability it will hit uh, right 50 cents. It will hit 50 cents. It has a very high probability. But if I set the target 110, it may have a 70% probability of hitting. So think about in terms of probability. That's why they say the traders need to know not only the technical skill but the risk management, the mathematics, the statistics, the probability, and all that thing. A lot of things to learn in order to be successful in trading. So high probability of stock pulling back significantly. So go on intraday level, like 30-minute chart, 1 hour chart, and analyze your red target. And before even so, some traders, they are so greedy that they just want to sell at the resistance level. So resistance is not just one price point. Resistance is a channel. So resistance is a channel. So define the channel, draw the rectangle line. Then you say, okay, this is my lower line of the resistance and this is the higher resistance line. So the lower line is, let's say, at 110, my higher line is defined at 112. So I know my resistance channel is between 110 and 112. So there's a $2 gap in between. So that is the resistance level. So if 110 is my target, I will not set my target to, if the lower line is 110, I will not set the target to get out at 112, because 110, that's where the game begins. So I will set my first of all, I will set my alert at 109. So I get the alert that the stock has reached 109. So when it reaches 109, now I know 110 is the line where the it's like a border. It's like a river crossing. So the river, one country is at 112 and above, and and then 110 is the another country. So let's say 110 is the Canada as the US, and 112 is the Canada side. So I will get out at 109.50 or something like that. I will not even wait for 110 unless it jumps above 112 and it travels to 113, 14, 15. Then I know that the river has been crossed, the resistance has been broken. Now I need to hold this stock because it's a brand new game. I'm in a brand new territory. I'm in a new country. So it's like that. So I send you the alert that the red target is hitting, sell the rest. If I know, I have sent you the alert to sell. If I have not sent you the alert before, then I will send you the alert to sell all or sell majority or sell half. But if I have already sent you the alert before, then I say, okay, please close the rest of your trade. So I already know. I may even open a new trade. So I close. So let's say I'm in a November calls and I'm holding it for 10 days. So, and it hit the red target and it crossed the red target. So at that time, I need to ask myself, if I was not in this trade, would I enter as in a new trade? So if the answer is yes, then why I am not opening maybe a December uh, trade or a January trade? I should close the November because time is running out. So I close the November strike, wait for the pullback, and then I open a new strike with the December because it's a brand new trade, a brand new entry. It has crossed the resistance level. So the stronger the resistance level and it's conquered, the higher the chance of the stock going up. And the reason it's happening because the sentiment has changed. There's a new catalyst. There is something there. There's a volume has increased. There's a price action. There's a lot of activity in the option. There's like a brand new thing is happening in that stock. So when that happens, you need to uh, treat it as a brand new trade. So taking action a red target. So when the stock gaps above the red target, I give you the targets alert. So we watch during the pre-market hours. So during the pre-market hours, what is happening to our open position? So I look at that during pre-market hours, what is happening to the watch list. So what is happening to the watch list? What is happening to the open position? What is happening in the futures market, cash market going to happen? What is where the market will gap up or gap down? So where it will land, and then what kind of a volume is there. So all that is analyzed for all the positions. So break, if it goes above red and crosses, come back down, then I send you the alert to sell immediately, or something is wrong. Sometimes the stock gaps up and the option doesn't move. So market maker just play the game. So when we see that, then we say, okay, we need to close it and move on. So revised red target is sent when let's say the stock has crossed from US territory to Canada. It just crossed the border. It just magically gapped up. Something happened, or a cannonball is fired. The resistance was like a China wall. It was a big resistance, a hard resistance, and the stock has done many attempts and it failed to cross. But today it crossing with a bang. So when that is happening, we revise the red target. Many reasons to revise the red target, either for the calls to the upside, for the puts to the downside. So revision of targets are done, send you the alert so you can take action. Maybe you're not in the trade, is fine. So now these are the kinds of trade alerts we send you. So we send you the alert just to sell 1/3 or sell half. Majority of the time, I'm sending you the alert to sell half or sell majority. So these two are the main trade alerts I'm sending you: sell half or sell majority or sell all. So sometimes I give you the price range to sell. So sell between $10 and $10.50 because the stock is doing its thing, and I know by the time the trade is delivered. So when the stock is hitting the target and you're looking at that time, you look at your option and the stock is about to hit the red target. So then you anticipate that by the time the stock reaches this red target, my option will trade in this range. So it could be the option is have a little wider spread. So the bid is at 950 and the ask is at 10. And there is still 60-70 cents left in your stock to move. So maybe you can set your order to sell at 980 or 990 because the stock is moving, and then you're shaving the spread, you're selling in between the bid and ask. So you are in this momentum, you're out. You're not out at the bid of 950, and you're not out maybe at the ask of 10. Maybe you're out at 980, 990. So we do that when this kind of a situation is happening, and sometimes sell to close by market. So if there's a 15 minutes left to the market and the stock has reached some kind of a major target and there's not much meat left, or there is a Friday, then I know it's a weekend or a holiday is coming, I send you the alert to close by market. Now there's another important this alert which traders don't pay attention is when your major target index is hitting some kind of a target, then that market hits the target, and so it does first. And then if you're not paying attention to that market where that stock belongs, or even if it doesn't belong, let's say you are holding a position which is part of the Nasdaq 100. So Nasdaq 100 hit some kind of a major target and you're still holding it and you're not paying attention to that major target, so your position is still moving, but eventually it will stall, and then it will start to pull back because the traders start to that symbol is part of that major index. When the major index start to pull back, your that position will be affected. So now sometimes the index has hit the target and your stock has not hit the target. So your stock has not hit the target which is based on the resistance. So if it starts to pull back, it creates the resistance below the resistance you have already defined. So now you need to close the position which for that market. So let's say the index Nasdaq 100 hits some major target and you're holding Apple and you don't close that Apple. Apple will is going up and you're just paying attention to the Apple. Apple will eventually start to pull back. So, and then when one index, if it hits a major target, then other indexes also follow. Either they will follow the one which is pulling back, or the one which is pulling back will pull back a little bit, and then it will start to move. So it's like a four horsemen. One horseman hit the targets, three are still moving, but then those three may follow that one which is pulling back, or the one which is pulling back follow the other three. So you have to analyze that also, that which one is the leader. There could be one or two market at any given moment is the leader, and the other is a laggard, and laggard is following the leaders. So sometimes the Nasdaq is the leader, sometimes the Dow Jones is the leader. So you have to know which one is the leader, which one is the laggard. So we do all that. Pre-market and after-market price action. So it's very important for you to watch the pre-market and after-market price action, because if the stock comes up, some earning or something happen and it's trading already at the resistance level which you have read before, and you have your target set based on the red target. So if you fail to read when the market opens, it has already hit that target and the selling has already been done at that red target. So when the market opens, and if you don't pay attention to that trading, you're waiting for it to hit the target and it's not hitting, because you had off, unless you have a stock and you sold out in the pre-market or aftermarket, so you're out, so it's fine. But if you have option um, trade, the option, it doesn't trade in the pre-market after, it's trading at the regular session. So when the regular session opens, so if the stock gaps up at 110 in the pre-market and your order for option is set at 110, so when the regular session opens, even though the stock opened at 110, but the option market is not open. So you're waiting for option market to open and you see the stock hitting the red target and you say, okay, why my option is not being sold? Because that option related to that symbol has not opened. And what happened, by the time the option market opened, the stock is already trading at 108. So you have to know that the pre-market, it has already hit 110, it has done its thing, now it's trading at 108, and I need to sell at 108. If you don't decide, if you don't change, you will lose. Maybe it will go to 105. So think about that. So we watch the pre-market, especially pre-market, and send you the strategy. So we send you the target reminders for during the pre-market hours. So we start sending you before 30 minutes of market open, the target reminder that this trade is trading, this stock is trading at this price and these are the targets. So we know that you have this option position open and you need to take care. So now we need to always look to maximize the gain in a trade. If we are in a winning trade, should not let it go quick. So once we are in a winning trade, we shouldn't be letting it go fast. So scaling in, add to the existing position. So not only average down, but learn to average up. So first of all, people say never, 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 never average down. So I don't. So this is my belief that never, never average down is not a good advice. You can always average down if you're in the trade. If you bought the option at when the stock was trading at 100, now it's trading at 95 and it has a strong support and is rebounding and is going to 97 and 98. So you bought at 100 and now it pulled back to 95, and 95 was a strong support and it's rebounding fast. So why not add to your existing position if you have the dollar allocated? So average down. Now, if you entered at 100 and the target is 110, it went to 105 and it pulled back to 103. Now it's moving sharply to the upside. So your option is already in the gain. So you may want to add a little bit more at the higher price. Maybe you open another strike, maybe a new month. If the time is running out in the existing position, maybe you open a new position with the new month, maybe a new strike, maybe create a vertical spread. So to lock the gains, and then you have a spread. So you can do all this, same stock, same trade, different strategies. I send you the alert on a news update, the technical, if I see some breakout happening, something happening, I send you the alert. Double top breakout or some resistance is happening or some volume is there or something unusual happening, I send you the alert. Sometimes I send you the alert to buy more. So if I see that, okay, the pull position has pulled back and now it's rebounding, I send you the alert to buy more. So you may receive the alert to buy more. Now, again, everything is based on uh, perfect kick. So just like Bruce Lee, if Bruce Lee was trading, then we need to ask, if Bruce Lee was trading today, what kind of a trader he would have been. Um, so based on Bruce Lee's, so think about it, he would have been consistent in his trading strategy. He would have been very disciplined, believe in abundance, that the money is there. He would have been continuously learning. He would be adapting his techniques and positions and his maneuver based on what the market is doing. He would have a lot of patience. He would have implemented robust risk management, so the other guy don't kick him, he kicks him, the other guy doesn't kick. He would have learned from his mistake, and he would have positive growth mindset. So this is what Bruce Lee would have been. So now again, these are two last quotes I showed you. Now I will show you the chart. So I'm switching to my another presentation, and I will show you some of the charts of the trade. Just a second, I'm opening the new presentation. I'll share the screen with you. So some trades which charts I'm showing you. So this is the para calls. So what I explained to you, those 12 or 13 um, techniques. So all these charts which I'm showing you, there's no volume, there's no indicators here, only the volume there and the price. But pay attention to the blue arrow. Blue arrow shows where the entry, and the red arrow shows where the exit. So this stock is going down for, you know, I don't know, God knows from where to where. On the chart it shows from 18, and it went down all the way to 10, and suddenly it starts gapped up and it starts to rise with a nice, very nice volume. So I went in, bought the calls, and then next day so I bought the calls on November 2nd. On November 3rd, it just gapped up. So I ask question first, shoot first, ask question later, because I have 80%, 7% gain. And on the left side, I look at it and I see some resistance here. So you see all this is a resistance. So what are the chances that I will make 100% gain? And what are the chances that I will lose this 87% gain? So think about that. If I have a 87% gain very next day, I take, compared to I wait for 150% gain after 1 week, because I may see 0% gain, or I may end up losing. So I closed very next day when it happened like that. So on November 2nd, I entered. November 3rd, I'm out from this trade. This is a Disney call trade. I entered on November 2nd and I gapped up to resistance and I got out. The gain is 31%, so it's not much. But look at the other position. So you're closing the trades, and then at the end you are coming up with your gains and loss. So 87% gain here, but 31% gain here. So now you have to ask, so the same trade, so you 87% gain, provided you allocated the same dollar amount. So if you just put only 500% $500 on para, and you made 87% gain, and so 87, and then you put, let's say, $2,000 on Disney. So you're not, first of all, you're not allocating the proper dollar amount. So that is wrong. So percentage gains of the dollar amount. So the dollar amount should be allocated same. Sometimes we don't allocate because we only initiate with the half position, and then we say, okay, we will wait to see where the stock will do its thing, and then I will wait for the confirmation, then I will add more. But the very next day the stock gaps up and then you're in the profit. So that's one thing. So the 31% gain, maybe the dollar amount is the same compared to 87%, but it should be, the dollar should be the same. Now here is another trade, DXCM call. So again, I entered on November 1st, and then after second day I exited with the 49% gain. So the breakout, pull back one day, and then the very next day is making a new high, and I entered. MA call. So this is the one I was telling you about, the MasterCard. So all the financials, they were going down. Only the MasterCard was reversing to the upside sharply. So I entered at MasterCard and then waited for the gap up and closed on Friday. Again, I closed on Friday with 88% gain. I also had a trade in Citigroup. So I'll show you the chart of Citigroup. So MasterCard and Citigroup were the one which are moving nicely. Others were just not doing its thing. So here is the C call on on November 2nd. So look at the MasterCard. So MasterCard was entered last week. Last week. So MasterCard was the one which was moving and others were not. So, but the on November 2nd, I saw Visa, Citigroup also doing its thing along with the MasterCard. So MasterCard is doing its thing, C is doing it, and then I exited both on the same day. Exited because of this resistance level. So I don't know what it will do. I have 54% gain, and the gap up occurred, and it has the resistance at 43. So I wait for 43 to cross and make 75% gain, or I close at 54% gain. So I close at 54% gain. Now, MU calls. MU, I had puts here, and then it started to reverse. So when it reversed, I closed my puts position at a loss. But then I reversed it. I reversed my position. So this is another thing. When we close a trade with the loss, then and we see the stock doing its thing on the other side, because we are paralyzed because we just took the loss. We don't um, open the position on the other side. So if we have a put position and it's turning and it's giving me a loss on this day, when I saw this, I said, oh no, I need to close my put position. So I closed, but then I need to open on the long side. So I put on the long side, and then after 2 days of gap, I close it. So I covered my loss on MU trade. So MU can go higher at this level, at 74 level, but why would I wait to reach a 74 when I can close at 73 at 50% gain, and then I have a weekend there? Because I don't know, maybe it will go to 74 and then it crashes down. So I'd rather take 50% gain, and a weekend is coming. Even if it goes from 73 to 74 on a Monday, it will still show me 50% gain. It will not show me more. So I close on Friday. Here's WBD. So again, another nice with the volume. So it bottomed and then it broke out with the volume. So look at the volume and it's breaking out. So what are the chances of WBD to come down then to go up? So bought the calls, and in the very next day when it gapped up to the resistance level, so look at the left side, how much resistance it has between 12 and 1250. So I close at 12. So 32% gain next day is good enough. I don't I don't want 50% gain, which is not there, additional 18%. So in order to make 18% gain, it can come at 1250, maybe on Monday, and I give back 32%. So I have to evaluate, I keep 32% gain or mm, go for another 18%, especially in options. Here's AI calls. AI have partial position is still open. It is facing some resistance at 30. So, but half of the position is sold at 30% gain. Here's another one, Tesla. So think about the Tesla. So Tesla is $800 contract, 80% gain, 800. So Tesla made dip below 200, and then when it started to rise and doing its thing, I went long around $203 something. So $203, I went long on Tesla, and then the next day it gapped up and then it pulled back to below 200, and then it closed again above 200. And look at the volume. And then when it gapped up, I closed my position with 80% gain. It went up further, but I closed at 80% gain, which was 800. Same way, this Charles Schwab, it's not much, but it's still 35% gain, along with the C and MasterCard. So C, MasterCard, Charles Schwab, they all combine into one financial. So if you have a MasterCard open, you have a C open, and then you're opening the Charles Schwab, they're basically in the same category. So you're increasing your risk in the same sector. If it goes down, then you will lose money in all three. So lock the gains in the Charles Schwab also. The Qualcomm. So Qualcomm, after tanking, it started to rise. I went long, and then when it gapped up to the resistance, close at 80% gain. I rather take 80% gain than to wait for 100% gain or 150 and then maybe not. And I see the pullback occurring and filling the gap. And the volume was high. This volume is high, and but it has a gap. So I rather close on this high volume in a gap, and when it's doing its thing, see up and down, up and down. So this is not a proper gap. So I closed it. Hello, so I watch Home Depot and Lowe together. So every day I'm watching Home Depot and Lowe's. So if there is some news or something is happening, so I evaluate whether I need to go long or short on Lowe's or Home Depot. One of them is moving. So I went long on Lowe's, 42% gain. Now I will watch again and I'll see Home Depot also. If it's Home Depot is doing its thing after pullback, I will go long on Home Depot. Here is ILMN puts. ILMN is just crashing. I did not notice this crash all the way till here. So you can see I'm very, very late. So the crash is happening at 200, but I entered at here. So I had a short window. So the target was 100 and 300. So as when it reaches 104, 105, I got out on a big volume day, and it could be a volume climax for ILMN. So I had 58% gain, I got out. The volume increased and it's reaching towards 100. So 50% haircut, it doesn't matter how bad the chart is looking. If somebody uh, is thinking that this stock has reached its fair value and it's time to buy the stock, they will start buying it. So they're seeing it at from 200 coming down to 100. So we have to be very mindful from 200 to 100, 50% haircut. Um, it could start to rise. So when it start to rise, the fundamentals are bad. So we can see the technicals are telling us that the stock fundamentals are really bad, and it's just tanking, tanking, tanking. So there, I don't know about the fundamental, but I'm sure it's very bad. Now, when ILMN start to recover to the upside, the fundamental will start to follow the technicals. Or if the fundamentals improve, this stock will gap up. It will not move in a normal fashion. It will gap up on any sentiment change or anything positive catalyst comes, the stock will gap up. But if it doesn't gap up and it start to rise, the technicals will lead. So it's like a feedback loop. So technical will drive the fundamental and the fundamental will improve. And then the stock starts to, by the time we realize, it's already trading at 150. So think about it, all the big boys, they start absorbing, let's say at 100, and they sell at 150, whereas we come and buy at 150. And then we see it pull back to 130. And then we worry, we wonder why we are losing money. Here's another one, NOC. So NOC, the defense, so it was doing its thing. It's like this. So it hit for it's expense. This NOC is under Queen stocks. It's a high price. Options is high, so I don't trade often. But during this day when I entered in the put, it was doing its this thing up and down and up and down during the whole day. So what are the chances that is when it's doing this, and this is the resistance at 490 and 495, a big resistance. What are the chances that if I buy puts, it will not come down and then it rather it goes up and cross the resistance? It could, but what are my odds? My odds are that I will make money on the downside. So I bought puts and I closed when it hit 20-day moving average. So 40% gain. Now, this is another financial. So COF, so COF, I have seen, this is what I have seen. The COF usually is kind of does its own thing. It's buyers are there. When there is no buyer, I don't see anything in the other financial. COF is the one which is kind of somebody is buying it. So I noticed that, bought calls. I saw 2 days of a pullback, and then when the gap occurred, I sold. So what are the, and look at the volume. The gap occurred, I sold at 95% gain. So what are the chances that I will make 100% or 130% gain after making 95% gain, or I lose all this 95% gain? and the volume is so huge. So when the volume is huge and it's gapping up, and if I have a position, I close my position. If the volume is huge and gap up, I will put this stock on my watch list. I may not initiate this because it has gapped from 91 to 100. So already gapped up from 91 to 100, and it gapped towards to the resistance level. So I don't know what it will do next, but I'm out. Here is the Microsoft puts. So look at this one, Microsoft puts. So Microsoft gapped up on earning. It gapped up to 345 and it starts to pull back. So instead of going, and the volume was huge. So look at the whole volume is huge and it gapped up. So instead of buying calls, so it's pulling back. So instead of buying calls, I went the other way. So I bought the puts. So what are the chances of Microsoft coming down? I mean, it can go up, but I'm I'm basing my on other side. So I'm going on the other side. So what are the chances of Microsoft to pull back? It did pull back. Look at this pull. So on the very next day, it pulled back and I had 100% gain. So what are the chances that if I hold this 100% gain and I say, okay, no, Microsoft is tanking and it will come down and it will go to 315 and 310, maybe 300, and I will make a lot of money? No, this is a gapped up and then it pulled back to 325, and then anytime the market moves up, it will go back up. It filled the gap and it will go back up. So I'm out. If the next day I have 100% gain, I'm out. This is TTD puts. Now I have a TTD call position. So I open a TTD put call position on Friday. But look at this. So same stock, it's just crashing. So I went short on this when it broke the support here. I went short on TTD puts, via puts. And the next day when it gapped down, I closed it with 60%, 1% gain. Now I have reversed my position and I'm long on TTD. So same stock, I don't care if TTD is tanking, is okay with me. If TTD is going up, is okay with me. I am not the CEO of TTD. Even I'm CEO, even the CEO may not be caring what it's doing. So whatever TTD, it could be a cat, it could be a dog, but if it's doing its thing, you go buy puts. If it does like this, you buy calls. It doesn't matter if TTD or dog or cat or what. Sig puts. So Signet Dwellers, I don't care, and you shouldn't. That if it's what it's doing, it's the chances are that it's coming down. I bought puts. Next day it gapped down. I sold immediately. What are the chances that it will continue going down? Maybe it will crash, but it's 56% gain very next day. Close it because there is another symbol waiting for me to open the position. There is something out there. Here is HES puts. So HES is the oil stock. So all the oil stocks, they are going down. Most of them, they are going down in a fashion, like a herd. They all start to crash together, or they all start to rise. So HES broke down, so I went short and I said, okay, where is the support? So 150 is look like it's a support for me. But I closed at a 30% gain because after it broke down, it did so the volume continuously for 2 days was up, and then the third day the volume is low and the candle is low. So I just close it. I don't know, maybe this is where all the selling have gone and they will start buying it. So I rather the volume was not there, so I just closed it at 30% gain. Here's a Riot call. So Riot is a small cap. When there was a buying at this big huge volume, so I went and bought the call. There was a lot of activity in the option also. A lot of activity in the option. The market is moving up. The small caps are moving up. The volume is huge. So what are the chances of me losing money in Riot in calls than to gain? So when it gapped up with the volume, I just close it. I rather take 75% gain and Riot than to wait for 100% gain and don't see 75% gain. NTS. So NTS, Chinese stock. So I watch Baba, Baidu, Billy. JD, PDD, NTES. So these six stocks, they are part of the other categories, but also part of my Chinese stock. So I watch Chinese and they move, they are moving together. If something is moving, I look at, oh, Baba is moving. Is Baidu also moving? What Baidu is doing? Amazon moving to, okay, let's see, JD is moving and PDD moving or not. Or if Baba is moving, what PDD is doing. If Baba is going down, PDD going down, or JD going down, what else is happening in Chinese stock? So I open up my Chinese basket and I see. So I entered in NTES here for whatever the reason was at that day. And then I closed it when started to rocket upward. I don't mind. It can go to 109, 110, but very next day, if I have a 50% gain, I close it. Coin. So I trade coin calls and puts. So coin, I and there was a this is was trading in a congestion, and this day was a kind of a bias to the upside. It's certain it starts when you look at the early morning rhythm. It the stock is telling you that it's doing its thing and it wants to go up. There is a certain interest there. So there is a like a horse when they move. So the stock is also doing its thing. Tuck, 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 tuck. It's constantly getting bought. Something is happening, constant rhythm, and the volume is building up. So I positioned myself as a call, and then when it gapped up next day, close it. I don't know where coin will go. It can go to 110.5, but I'm holding November calls and I need to close it or December calls. So 77% is better than 100% gain. So this concludes um, my today's presentation, and this will be posted on my YouTube channel, Real Trade Genie, and there are other presentations there. And I will see you next week, not this week. I'll see you next week. And if you have any question, please send me to success@TradeGenie and I will answer. So I'll see you next week. Thank you. Bye.